Welcome to the Deep Dive, the place where we filter out the market noise and hopefully give you some clear signals.
That's the goal.
Today we're looking at the Dixie Group, ticker DXYN. They're a big name in floor coverings.
Right. Carpets, flooring, that sort of thing.
And we're focusing on their Q2 2025 earnings call because there's this paradox we need to unpack.
Yeah, it's pretty interesting.
They managed to double their earnings, doubled them, in a housing market that was, let's be honest, pretty terrible.
Absolutely hostile, yeah.
Mm.
High rates, low sales, tough environment.
So the mission today, how do they pull off that win on the bottom line? And maybe more importantly, why did the market basically just shrug? The stock went nowhere.
It really is a fascinating case study. You've got this really strong internal execution playing defense perfectly.
Butting heads with these massive macro headwinds that they just can't control.
Exactly. It's all about managing what's inside the four walls when the outside world is, let's say, uncooperative.
Okay, so let's get into the results that set this whole thing up. Top line first. Revenue came in at $68.6 million.
Which is down about 2.7, maybe 2.8% year over year.
So definitely feeling the pressure there. That reflects the housing market, right? High rates, slow turnover.
No doubt. That's the challenge. But like you said, the victory is really on the bottom line.
Yeah, GAAP earnings per share, the EPS, hit 8 cents.
8 cents, and that's up from 4 cents in the same quarter last year. A straight 100% increase.
Net income too, right? Doubled.
$1.2 million versus only $600,000 the year before. So yeah, this isn't a volume story at all.
Not even close. It's all about the margins. Purely a margin story.
And that margin number is really the key. Gross margin hit 29.2%.
Which is a significant expansion. What was that, about 110 basis points year over year?
Yeah, roughly 1.1 percentage points better.
Yeah.
And that flows down. Operating income jumped about 39% to $3.2 million.
So let's just pause there. Revenue shrinks a bit, but operating income jumps nearly 40%. Net income doubles.
It's a stark contrast, isn't it?
Yeah.
It screams operational efficiency, like surgical cost control.
They're running a much, much tighter ship than they were a year ago.
Absolutely. It allows them to turn slightly lower sales into significantly higher profits. This is impressive execution.
The market reaction, despite doubling EPS, despite that margin expansion, the stock just sat there, closed flat, around 50 cents on the day of the call.
Yeah.
So what gives is the market just saying, nice job, but we don't buy it long-term without volume? Or is it just micro-cap problems, liquidity?
I think it's probably a mix of both.
Yep.
You know, the market definitely saw the execution. You can't miss doubled earnings.
Right.
But the fear around housing, those sector headwinds, they just overshadowed it immediately. And liquidity, yeah, that's always a factor with these smaller names.
How much volume did it trade?
Around 77,000 shares, which, okay, that's actually high for DXYN.
But still pretty thin in the grand scheme of things.
Exactly. Thin volume means investors are slow to react, slow to re-rate the stock, even on genuinely good news. So that flat performance tells you the market sees this as defense, maybe necessary defense, but not a sign of imminent growth.
Okay, so let's dive into how they built that defense. How did they achieve that margin resilience? Because doubling earnings, that doesn't happen by accident. It takes real structural change.
No, it was very intentional. Management confirmed they're deep into a pretty aggressive cost reduction plan. They're targeting $12.6 million in savings for the full year 2025.
$12.6 million. For a company this size, that's a massive number.
It is. And crucially, this isn't just a promise. They said about half of that, so maybe 6 million plus, was already achieved in the first 6 months.
Wow. Okay, so they're on track.
Looks like it. That kind of progress gives you confidence that the full $12.6 million is likely coming. And that puts a known lower floor under their operating expenses going forward. That's structural improvement.
And that feeds directly into the gross margin, that 29.2% figure. You said it was mix and cost cuts.
Primarily, yes. Two main levers. First, shifting the product mix towards their premium soft surface stuff. You know, carpets where the margins are naturally better.
Makes sense. Focus on profitability.
And second, just those aggressive cost reduction initiatives hitting the cost of goods sold line.
Did they say anything about raw materials? That's always a big factor in flooring.
They did. And it was actually helpful. Raw material costs have continued to ease off, apparently. Some continued price reductions. So no inflation headwind there, maybe even a slight tailwind helping that gross margin.
Okay. And they mentioned LIFO accounting. How did that play in?
Yeah, they clarified that. So LIFO is last in, first out.
Yeah.
When your inventory costs are falling, like with their raw materials.
The last stuff in, the cheaper stuff is assumed to be sold first.
Exactly. So those lower material costs flow through faster under LIFO, reducing the cost of goods sold reported in the period. It gave their gross margin an extra little boost.
But it's a boost built on real cost savings, not just an accounting trick.
Correct. The underlying cost reduction is genuine. LIFO just helps reflect that benefit more quickly in this environment.
Okay, that makes sense. So the cost savings are real, the accounting captured it. What about the balance sheet? You mentioned defense, cash efficiency.
Absolutely. They're showing real discipline there too. Proactive capital management. We saw a pretty significant reduction in net debt over the first 6 months.
How much?
The net balance, so senior debt minus cash, was down to $45.6 million. That's a $4.4 million decrease just since the end of last year. They're actively paying down debt.
And inventory. Always key in a slow market. Don't want cash tied up in warehouses.
Right, and they're managing that tightly. Inventory levels are down to $67.4 million. Compare that to over $76 million in Q2 last year.
So they're freeing up cash there too.
Definitely. Converting inventory into cash on the balance sheet. And look at their CapEx plans. Capital expenditures.
How much are they spending?
Almost nothing. They plan to hold CapEx to just $0.8 million for the entire year. Just basic maintenance.
0.8 million. What's their depreciation?
Estimated depreciation is around $5.2 million.
So they're spending way, way less than depreciation. That's pure cash conservation.
Total focus on cash flow generation. No expansionary spending right now. They are, like you said, hunkering down.
Okay, so the internal picture is clear. Cut costs, manage cash, optimize everything. Now let's look outside again. The battlefield. How are they pulling off these margins when the macro is so rough?
Yeah, management was very blunt about the environment. They kept pointing to high interest rates, low consumer confidence. Those are the killers.
And existing home sales are the key metric, right?
Absolutely. Stuck near that 4 million unit annualized level,
Right.
which is historically very, very weak. That's the biggest drag on their business.
And yet their main business, soft surface flooring, carpets, was relatively flat year over year.
Flat, which in this market is actually pretty good. Management thinks they significantly outperform the overall soft surface industry.
Really? What's the industry estimate?
They estimated the industry was down around 7%. So being flat means they must be taking share.
Okay, so where are they winning?
Specific niches, mostly at the higher end. They called out their Duracell collection, which targets the polyester segment where they're gaining ground, and also their high-end decorative products. Things like pattern carpets, wools. That segment actually had one of its strongest quarters ever.
Interesting. So even when the housing market's slow, people still renovate or focus on premium upgrades.
Seems like it. That high-end discretionary spend, especially in existing homes, seems more resilient. And DXYN is capturing that.
What about hard surfaces? That's a smaller piece for them now.
Yeah, less than 15% of revenue. And it was more of a mixed bag there.
Okay.
The really high-end Fabrica wood program did exceptionally well, grew nearly 10%.
Wow.
But the bigger part of hard surface, the luxury vinyl tile, LVT, SPC, WPC products, that was much more challenged.
Why is that? More competition.
Tons of competition.
Yeah.
And there were broader inventory issues across that whole segment of the industry. Everyone seems to have too much LVT right now.
So it makes sense they're focusing more on their U.S.-made soft surface lines where they have better control and margins.
Exactly. It's a smart strategic shift given the market dynamics.
Let's touch on supply chain and tariffs, too, another area where strategy matters. They're out of China now.
Completely. Confirmed they no longer source from China at all, which is prudent given all the tariff noise.
Right. Do the current tariffs hit them much?
They mostly impact the hard surface products and some decorative items, but since about 85% of their total sales are manufactured here in the U.S.
It's a relatively small impact overall.
Right. They're largely insulated. And they said they put through pricing adjustments after the last round of tariffs in April.
And they plan to offset any future tariffs with more pricing.
That's the plan. Manage the risk, pass it through where possible. Playing defense there, too.
Okay, so bringing it back to the investor view, we talked about the muted stock reaction, and part of that you mentioned was the lack of guidance.
Yeah, they didn't give any formal financial outlook for the rest of 2025, which, given the uncertainty with rates and housing, it's prudent.
Understandable, but it doesn't help the stock price. Limits visibility.
Definitely contributes to that stagnation. It leads to the big question for anyone looking at this. When does the tide actually turn?
What did management say about that? Any signs of hope?
They clearly see their current strategy, cost cuts, premium mix, as the bridge they need to cross to get to the next cycle. They pointed to potential long-term catalysts.
Like what? Lower rates?
Lower mortgage rates, absolutely, and improvement in consumer confidence. And importantly, they talked about pent-up demand.
Ah, the coiled spring theory.
Kind of. They noted that family formations are still happening, outpacing new home construction, and homeowners had a ton of equity built up.
So eventually, that demand has to be released.
That's the bet. They even brought up a historical comparison after the 2008-2009 crash.
Yeah.
The flooring industry saw 4 straight years of 8% compound annual growth. So they're hinting at that kind of recovery potential eventually.
So the core investment idea here is, can they keep these 29% gross margins going? Can they sustain this efficiency until the market volume finally comes back?
That's exactly it. If they hold this lean structure, any real recovery in housing sales should translate into massive earnings leverage. It turns this margin-first story into a powerful profit engine.
Okay, that potential leverage is a perfect setup for our This Is Not Financial Advice segment. Time for an outrageous but plausible trade idea based on this call.
All right, let's frame it. We've got a microcap stock, DXYN, proven execution right, doubled EPS, cost savings are real and hitting the bottom line.
But it's trapped, stuck in this nasty housing downturn, and the stock price reflects the fear and the thin liquidity, not the recent performance.
Precisely. So the outrageous but plausible idea, it's a leverage bet, maybe a long-dated swing trade, and it's betting purely on that cost-cut conversion.
Explain that. What's the premise? Simple premise. The stock's valued based on today's depressed volumes. But we know they've taken out significant structural cost. That $12.6 million program provides a known lower expense base, a floor.
Okay.
So if existing home sales just stabilize, we don't even need a boom. If they just stop falling and maybe tick up slightly, get consistently above that 4 million unit level.
Their fixed costs are now lower, so profits should jump disproportionately.
Outsized earnings leverage. That 50-cent stock price doesn't reflect a business that can potentially earn significantly more on only a modest volume recovery because its cost structure is so much leaner now.
So the trade itself, go long DXYN.
Long DXYN. And the catalyst you're watching for is Q3, Q4, showing maybe some seasonal strength, but critically, showing they can hold those 29% gross margins.
It's a bet that the market eventually wakes up and prices in the cash flow potential from the new structure, not just the current slow sales.
Exactly. It's a bet on efficiency converting into leverage when the macro just stops getting worse.
What's the main risk? Liquidity, hands down. It's a microcap. Getting in and out can be tough. Price discovery is slow. If things go wrong, or even if they just stay stagnant longer, it could be hard to exit cleanly.
And the reward.
Rapid multiple re-rating. If housing shows even modest improvement and those margins hold, the earnings leverage could be dramatic, and the market might quickly reprice the stock much higher.
Okay. So, to wrap it all up, we dove into Dixie Group. Impressive execution, no doubt. Doubled earnings, soaring margins thanks to that big cost-cutting program.
Textbook operational defense.
But the market barely blinked. No guidance, weak housing outlook. It kept the stock pinned down.
Management's playing the hand they were dealt seemingly perfectly. Cutting costs, managing the balance sheet, focusing on premium niches.
So the final thought for you, the listener, is really about timing and conviction. They've built this potential earnings power, but it's currently masked by the terrible macro.
Right. The question is, how long can they sustain this peak efficiency before something gives? Or, conversely, how quickly will the market reward them if those housing clouds finally start to part?
Which happens first? Do they run out of efficiency gains, or does the volume finally arrive to unlock all that leverage they've built? Something to think about. Thanks for joining us for this deep dive.